Let's start up with China, because about an hour back, your colleague John Woods very eloquently told us to avoid Chinese equities for now. The counter argument to that is that some of these are, if not the largest, a very big part of this market is very cheap. And that's really what the bulls have latched onto. Just flesh out that idea for us.
Yeah, so look, we're here at the 12th China Investment Conference, where I think the point is, rather than a broad-brushed approach where we can say that the China market is too early to invest, I think that what's important is we look into the detail of a series of sectors that are definitely investable. I think that the market is being driven by regulation, and the further away from China you get, I think the less understanding there is around that regulation, around common prosperity, what it actually means for the long-term growth of the country, and therefore the opportunity that that represents from a sector perspective.
Neil, how does the earnings season at the moment inform your macro outlook? You know, we just take the US side of things here, first of all. Of course, you can transpose this into what's going on in this part of the world, but we've got margins looking very strong there. It does suggest that the energy crunch, though it is perhaps in the latter part of the quarter, and indeed these high commodity prices, are actually being absorbed and the costs not really being passed to the consumer as much as you'd expect. What's your take?
Yeah, so look, I mean, we've seen that in recent numbers that, there's clearly some shock as a consequence of supply chain issues that we've had across the board. But I think as we continue to move forward, we're going to see a bit of a rebalancing. I mean, you've got a global economy that is coming out of the pandemic, and we've obviously seen a very high amount of consumer spending. I think as the social distancing eases up across different countries, and we begin to see more spending from a services perspective, we'll begin to see a little bit of a rebalancing, particularly from an inflation perspective, and we can look forward. It's obviously going to come down to growth, but we obviously need to look at the specific sectors that we think are going to continue to drive growth, particularly as it pertains to China. And I think we've talked about a few of what those sectors might be, particularly investment in things like green technology. There's still a lot of opportunity for us to be looking at right here in Asia.
And so, as you guys hold a house view of just neutral on China at the moment, I'm just wondering, what are you seeing in terms of flows and where your clients are kind of rotating to at the moment?
Look, from a China flows perspective, I think there's a couple of different dynamics. One, I think, as I've said, like the global investors still don't have a huge amount of appetite given the concern that they have around regulation. But at the same time, you've got a market that is opening up rapidly. You've seen from a QFII perspective, 140 new QFII quotas be approved over the last year. You've seen IPO reform. You're seeing more foreign brokers get approved to be able to invest in the market. So when you look at things like southbound flow that we have seen pick up, while the overall appetite around China in its broadest sense may not be as high, there's still a huge amount of investor interest as this market continues to reform and open up and present a huge amount of opportunity, which is where I think the timing of CIC has been very helpful in giving a level of detailed overview around what's happening onshore and the areas that we should be having a closer look at.
Neil, talk to us about your other area, of course, which is EMEA, because that's one market that was interesting this year. It front-loaded, if you will, all the goodness, and then things have really come off the wheels recently. What are you seeing from your perspective?
Yeah, so look, Europe, I think, is coming into a period where it should actually present a decent amount of opportunity. We're obviously waiting to hear what the Fed has to say tonight, but we're clearly expecting we are going to be moving into a higher rate environment over the next while. Europe is heavy on old economy sectors, and therefore it should be a key beneficiary when you look at the valuation difference between the large US, particularly tech sectors, and where we are from a European perspective. We are hopeful that you'll continue to see what we have seen to some degree is a pickup in interest in EMEA overall. So I think we're very constructive around the next little while when it pertains to Europe.
And then in NVIDIA's position, both the Bank of England and the ECB seeing interest rates really in focus as inflation ratchets up. I mean, we've got inflation in Germany at 16-year highs or something like that. Give us a view on how that really at the moment plays into what strategy you employ.
Yeah, so I mean, I think as I said, when it comes to inflation, you've got to look at the drivers of inflation. And again, it's very different as you move country to country, depending on where we are in the reduction of social distancing. But look, as I say, with fears around inflation, we're going to be moving into a higher rates environment. You need to be looking at the portfolio that you have, adjusting to account for that. And again, I think that means looking at a slightly more defensive portfolio, but equally looking to ensure that you've got a bit more of an old economy focus versus where we are today.